Financing industrial buildings in today's market. And industrial real estate has become one of the strongest performing commercial property sectors in the United States, fueled by e-commerce growth, supply chain reshoring, manufacturing expansion, and increasing demand for logistics facilities. Industrial properties continue attracting both investors and owner users in Houston, in Texas, and nationwide. Now, however, securing financing for industrial buildings in today's market requires understanding lender expectations, property fundamentals, and your available loan options. So whether you're purchasing a warehouse, a distribution center, a manufacturing facility, a flex space property, or an industrial investment asset, understanding how lenders evaluate industrial deals can help you secure better financing terms and maximize your return. So let's talk about why industrial real estate remains attractive. Industrial assets have demonstrated strong resilience through multiple market cycles because they support essential business functions in our economy. So think of warehousing and manufacturing and logistics and distribution and last mile delivery and e-commerce fulfillment, but also contractor storage and service businesses. Now, unlike some commercial sectors facing uncertainty, industrial demand remains supported by long-term economic trends. And some key drivers that help are the growth of online retail, supply chain diversification, but also the domestic manufacturing expansion, particularly in Texas, and population growth in Sun Belt markets, and increased demand for distribution infrastructure. And as a result, many lenders continue to view industrial properties favorably right now. So let's talk about what lenders look for in industrial properties. And every lender evaluates risk differently, but most focus on several key factors that we're going to talk about. First being the property type. And industrial buildings vary significantly. You've got warehouses, you've got distribution centers, you have flex industrial, you have manufacturing facilities, you have cold storage facilities or R&D space, or industrial outdoor storage or IOS. And certain property types receive stronger lender interest due to broader market demand and easier resale potential. Two is occupancy and cash flow. So for investment properties, lenders primarily focus on the current occupancy levels in the building, the rent roll quality, the tenant creditworthiness, the WALT, the lease term that's remaining, and the net operating income driven from the property. And properties with strong tenants and stable cash flow typically receive more competitive financing offers. Three is debt service coverage ratio, or DSCR. And industrial lenders commonly require a DSCR of 1.2 to 1.35. And as a general rule, higher DSCRs generally result in better pricing and lower risk premiums, but also increased leverage opportunities, so more loan. Four is loan to value, or LTV. And these typical leverage ranges include, and we'll look at the property type and the typical LTV, but stabilized industrial is 70 to 80%. Single tenant industrial is 65 to 75, and manufacturing is 60 to 75, and value add industrial is 60 to 70. And bridge loans are usually in the 60 to 75% range. The stronger the property and the sponsorship, the higher the leverage potential can be. So let's talk about some common financing options for industrial buildings. Conventional bank financing goes first, and traditional banks remain one of the most common financing sources. And these are best for owner users, for local investors investing in local properties, but for stabilized properties as well. And some typical features are usually a 5, 7, or 10-year fixed period with a 20 to 25-year amortization and competitive interest rates with recourse guarantees. And there's credit union financing, and credit unions often provide a little bit more flexible underwriting, but also competitive pricing in relationship-based lending. And these lenders can be excellent options for owner-occupied industrial buildings, for SBA financing, for owner users occupying at least 51% of the building, or for SBA 504. And those are ideal for warehouses and manufacturing facilities and industrial owner users. And some of those benefits, you can leverage up to 90% financing. You get a long-term fixed, a lower down payment. There's also CMBS financing, so commercial mortgage-backed securities, or CMBS. Financing works well for larger industrial assets and stabilized properties, and investors who are seeking non-recourse debt and raising capital. Some advantages there are as you offer higher leverage, long-term fixed, 5, 7, or 10. It's a non-recourse structure. There's life company financing. And life insurance lenders often provide some of the most attractive terms available. And they're best for institutional quality industrial assets and strong sponsorship and long-term holds. The benefits are usually some of the lowest rates, longest amortizations, flexible structures. There's also bridge loans. And bridge financing can be very valuable when you're acquiring a vacant industrial building, or repositioning a property, or if you need to fund improvements to the property, or if you're leasing up vacant space in the building. And bridge loans provide you speed and flexibility when traditional financing just isn't immediately available, or it's a non-bankable type deal. So let's talk about why technology is changing industrial lending. And historically, commercial borrowers had to contact numerous lenders individually to compare the options. And today, with technology-driven lending marketplaces, those marketplaces are transforming the process. In CommLoan's Cupid platform helps match borrowers with lenders based on property type, loan structure, leverage requirements, and borrower experience, but also their investment objectives. And through a network of more than 700 lending sources, borrowers gain access to banks, to credit unions, to agency lenders, to life companies, to debt funds, to CMBS lenders, and to private capital sources. And this technology-driven approach helps investors identify financing options more efficiently while also comparing rates, the terms, the prepayment structures, and lender requirements. And the platform supports a wide range of property types, including industrial, multifamily, retail, office, hospitality, self-storage, and even special use assets. Industrial financing strategies for investors and stabilized warehouses. So consider bank financing, credit unions, life company loans, CMBS financing, or value-add industrial. And for those, you might want to consider a bridge loan or a debt fund or private capital. Say it's for an owner-occupied facility. Well, think about SBA 504, SBA 7A, conventional bank financing, or a large portfolio acquisition might lead you towards a CMBS product, or a life company, or an institutional debt fund. So final thoughts for the day is that industrial real estate continues to be one of the most attractive sectors in commercial real estate, with strong, sticky tenant demands, and they don't like to leave because there's a lot of money and time invested, but also expanding logistics infrastructure and continued economic growth creates significant opportunities for investors and owner users alike. And the key is securing the right financing structure for your specific property, your business plan, and your long-term objectives. And with access to over 700 lenders and thousands of loan programs through CommLoan's technology platform, borrowers can efficiently compare financing options across banks, credit unions, life companies, CMBS lenders, debt funds, and private capital providers. And if you're considering purchasing, refinancing, or developing an industrial property, understanding today's lending landscape can make the difference between a good deal and a great one. That's it for the day. Please visit my website, billrapp.comloan.com. You can price out a deal and request a call back there. Love to have a conversation with you. Thank you for watching. Have a good day.